Hi, I'm Amey Abhyankar from FinQuest Institute. In this video, we'll introduce ourselves to an important concept called as interest rate parity. This explains the relationship between interest rates and FX. Now, market participants, including traders, risk managers, investors, may be interested in what is the estimated exchange rate for a certain currency pair at a specific time in the future. So the reasons for this can be manifold. They are trying to price a certain product, or they are trying to hedge a certain cash flow which they are going to receive in at a certain point in time, capital T, or they are trying to decide on a certain trading action. So interest rate parity is an equation which helps us estimate what the FX rate is going to be at a certain point in time, capital T. Let's say we are focusing on USD INR currency pair. So to understand the terms in the equation, FT is the expected USD INR exchange rate at a time capital T in the future. S0 is the current going USD INR rate. RDC is the domestic currency rate and RFC is the foreign currency interest rate. Now, how does one decide which is the domestic currency and which is a foreign currency? So when you're starting out on using interest rate parity for the first time, one crude way to remember this is the way in which the currency is quoted. So imagine that the USD INR rate is given as 75. So we can write this as INR 75 per US dollar. So the way to interpret this is 1 unit of US dollars is equivalent to 75 units of INR. So whenever we have a certain currency which is quoted as per unit of a certain currency, that per unit of currency becomes the foreign currency. So in this case, USD is considered as a foreign currency and INR is considered as a domestic currency. So likewise, I can go to any market data provider. I can fetch the USD rate for time period capital T. I can plug it in RFC. Likewise, I can look at the INR interest rate curve. I can fetch the required rate for capital T in for tenor capital T in INR and plug it in RDC. Now, in the FX markets, for every currency pair which we look at, there is something which we call as a leading currency pair. So I'll write a few currency pairs and there we'll try to understand how do we figure out which is a domestic currency and which is a foreign currency. So we have already discussed USD INR. Now let's try to write a few more. Now these are the standard ways in which currency pairs are quoted in the FX market. So if we have a British pound and USD, it's a GBP USD pair. So in this case, GBP is assumed to be the foreign currency, USD is assumed to be the domestic currency. If we have a USD JPY pair, then USD is assumed to be the foreign currency, JPY is assumed to be the domestic currency. If we have Australian dollar versus US dollar, then AUD is assumed to be the foreign currency, USD is assumed to be the domestic currency. So so you see, this is an easy equation to solve. Only once we figure out which is the appropriate domestic and foreign currency, it's a straightforward equation which will help us estimate what is the expected FX rate at a certain time in the future. So go ahead and try to estimate FX rates for different currencies. In case of any queries, feel free to drop in a comment and we'll be happy to help you out. Thank you.